a lender, and Oregon gave me a mortgage banker's license without taking a test or anything. I just paid the money. So I started a hard money company. I had a couple partners from Napa when I lived at Silverado for 10 years. And we seeded it with about $5 million in cash, went out and got about $30 million in bank lines of credit. And in 2001 into 2002, I cycled out of buying the foreclosures and just started lending all these guys money instead of doing all the work. I ran that up really well to about 2007 and a half. And I think everybody knows where I'm going with this. So by the time I had that ran up, I had 24 employees. I was doing 30 to 40 loans a month, hard money loans, all high value, high profit loans. And once 07, 08 hit, the majority of what I was doing was the BRRRR, what's commonly known now as the BRRRR strategy. We would lend the hard money to people that would buy a asset in the Midwest, Detroit, Cleveland, Memphis, Jackson, Mississippi, Chicago. I was in every market in the Midwest. And then they would get a rate and term refi and pay us off, and then they would end up with a cash flow rental. And they would have literally no money in the deal. And a lot of times they would get $4,000 to $8,000 per property back as refi proceeds. So you can imagine the marketing companies that I hooked up with in LA were selling this. And, the modern version of those, I think everybody knows who they are. But it was pretty easy. They had a 1 hour radio show in LA, and they would just get on and say, hey, I would make them have $1,000 a house, big skin in the game, right? So they would say, if you got $4,000, a 680 credit score, we can get you 4 rental properties that are going to cash flow at $150 a month, and you'll get $20,000 back cash in your pocket. So you can imagine how many of those I did, a couple thousand of them. And so I had the turnkey operators in the Midwest. I had the sales guys in LA. I had my 25 people running all this stuff. And then the GFC hit, and all bets were off. A little of that is happening now, where you're seeing credit start to freeze. But in the GFC, it froze solid.
What's GFC, Sandra?
Yeah, that was 07, 08, 09, 010, the great financial crisis.
Oh, that's what you call it.
Yeah. So we ended up with all these loans out and no refinances. And I had all these investors in LA and the Bay Area and New York and Miami that were stuck in my, 15, 18% hard money loans. And there was just no way they could, even though the property was stabilized and rented, they were still negative cash flow. And then, of course, being a hard money lender, you don't report to FICO. And they really had no cash in the deals anyway. And so they just started defaulting one after another. And that's when I ended up owning about 250 houses out in those areas, because it was our own money. Took those all back. We lost millions upon millions of dollars because the rental properties in those markets did not hold. A lot of those markets, the rental properties were, like in Detroit, when I first started in Detroit, the houses were appraising for 140 to 160. And we were doing hard money loans at 80 and 90. 4 years later, you couldn't get 20 grand for those houses. So a lot of the people that have jumped into real estate in the last 10 years, they came into it after 2010, and they bought the $20,000 houses. They don't realize a guy like me donated a ton of my net worth so they can buy their house at 20 grand. So then I got through that, bloodied and bruised, and then I just started out again and kind of built it back up. I got into doing new construction. We do a lot of new construction. And then we do we still do a lot of short-term bridge financing for developers and flippers. And that's gone pretty well, although we've had some bumps in the road. It's not been perfect. It never is when you're doing any kind of volume. So that's kind of where we sat right now. We have a 90-lot project in Canby, Oregon that comes out of the ground in June. New construction at the $500,000 to $600,000 price point. We're very active in Charleston, South Carolina with infill. I've got infill going in Indianapolis, new construction there. So that's pretty much the rundown of what we're doing.
Okay, that's great. So for people that joined late, just quick recap. So Jay has 45, 50 years of experience. He basically started when he's 6. I'm just kidding. But anyway, we're kind of going through the lessons or stories that he went through, and hopefully to apply to this current cycle. If you have any questions, feel free to pop them in the chat box. I'll make sure to get to them. There's a lot to unpack, Jay, if I may kind of unwind a little bit. So the first, you mentioned about the developer in San Mateo. That was like early 90s timeframe, you said?
Yeah, it was late 80s, early 90s.
So that was kind of the savings and loan cycle?
He got caught in the S&L crisis and tax reform, where they had set up all these syndications with exotic tax plans for the investors. And then when tax reform came in, a lot of the investors got hit with tax bills.
So is that the first sort of down cycle you experienced, or was there another one before that?
Well, no, the early 80s was the interest rate of 18 to 20%. And then when I first got in the business, I was too young to know we were basically kind of in a recession right after the Vietnam War. So I'm going way back. I mean, I don't know how many people remember the Vietnam War.
So
I was telling a friend of mine, when I was in grade school, we used to get underneath our little cubby desk for nuclear war training. The bell would go off. Okay, the bomb is coming. Get under your little cubby, like it was going to save you. So.
Okay. And so some of this is really for my benefit as well. I mean, I was born in '83, but obviously I have no idea what the heck was going on in the world. Maybe quickly, could you give us some context on what, like you did already, or what was kind of the economic or political background that caused some of these cycles, and how we kind of unwind
that's
it,
a good point. Nothing repeats itself. The interest rates of the early 80s, I was too young in the business to really understand why that happened. It was just Jimmy Carter was the president, and for some reason the interest rates just skyrocketed. I mean, we were selling.
Was this part of maybe a fallout from Reaganomics, or?
No, Reagan wasn't president yet. He hadn't even come in yet.
Oh wait, yeah.
I think the syndicators that had the Tax Reform Act was Reaganomics.
Right.
And the S&L was more akin to like the GFC, bad lending practices, right? And then you had the little blips. You had the .com bust, which was very, very pronounced in the Bay Area, and then 9/11 was just that was very short-lived, which is, I'm hoping the coronavirus kind of matches 9/11 or bubble.com. But what I'm seeing happening right now is, and I think what we can take that's really important for folks is they're realizing that max leverage without proper reserves is as risky as people say. Oh, buying real estate for appreciation is gambling. Well, buying cash flow real estate without proper reserves is just as much gambling. And so you're seeing those now, a lot of people now and their lenders are telling them, no capital improvements, shore up your reserves, And I think coming out of this, that a lot of the investors that are into the cash flow side of the business will look at things as like, it's not how quick can I get to 100 units. Can I get to 50 units and have enough reserves to carry a year if another virus could come or some weird thing could happen. So there's a lot of people stressed out right now when I've posted on Bigger Pockets, where people will get on there and like, well, if I don't get rent in 2 months, I can't make my payments, you know? So I think if there's any learning experience here is reserves. If you're in the cash flow real estate business, reserves are a very important component of that to make sure you got the money to carry through if you have an upset in your income. And the short-term rental folks in the Airbnb, I guess they're same thing. A lot of people that are they're counting on that, and if it doesn't come in, what do you do?
How much reserves would you recommend people to have?
I think for rental properties, it can't go up exponentially. You can't say I need 6 months reserves, which is $6,000 for one rental house, and I have 100 of them, so I need $600,000 in rentals, right? In reserves. I think it just kind of grows as you grow your portfolio, because if you have 100 properties, you're not going to have. Maybe you look at your reserves. I need to have 6 months reserves at a 30% vacancy factor. You know what I mean? But if you only have like 3 or 4 or 5 properties, I personally would have 6 months reserves for all of them, just in case. And then if you don't spend it, you don't spend it. But I think it's very important that you have your reserves, and financing and debt can be a little bit of a double-edged sword,
Yeah. So if I may go back to that first developer you work with, what happened to them, or what exactly happened in the tax reform that maybe triggered a bunch of?
Well, what it was is when you invested in a syndication, you had 3 class of investors. You had an A and a B and a C. A class could be your really high earner that doesn't want any cash flow, but they're going to take all the tax benefits. Okay, they're going to get, they could take the depreciation and the tax benefits, and they could manipulate them to the class of investors. The B class investors would get, like half the tax and half the cash flow. Then you had the C class investor that got no tax benefit and just cash flow. So when the tax reform hit, the A class guys had recapture on all that depreciation that they took, but they didn't get any cash flow out of it. And that was one of the major issues that happened to the syndicator I worked for that was based in San Mateo.
What do you mean by that? Meaning they had a giant tax bill because of the recapture?
No, their clients did, and so their clients were not happy.
So and they pulled a fund, and that's why they kind of went out of business.
And then 89 and 90 hit, and we went into a recession, and they had gone into real estate, into land development, which didn't work as good as they, like the Wildwood project that I was on. I mean, the guy that ran the company, he lost probably $5 million on that one deal. And they had also gone into senior care, and those weren't working as well. They had student rentals that weren't working. And then the one that was kind of the camel on the back was they had invested in Texas. And they got hammered in Dallas because they had bought apartment buildings down there, and new apartments were being built. You had wars over tenants. Next thing you know, they had too many vacancies. They couldn't debt service. And then the Texas banks came after them and were able to get judgments against them. and that really hurt them. So it was a combination of things.
Okay. And again, more of a history lessons for me. What real quick, what was happening in regards to the savings and loan crisis and kind of how that spilled over to real estate?
Well, the S&L crisis, I wasn't involved with the higher level stuff as much to really know, other than there was just a ton of defaults and a lot of bigger commercial properties, were sold, and there was a huge amount. I can't remember, Resolution Trust, or there was some trust put together that had taken receivership of all these assets, and there were some smoking deals that happened. One of them was where I lived at Silverado. that whole property, that whole resort, sold for $27 million. The whole thing, and it was worth probably $100 million at the day on that day. There was just fire sales everywhere.
And what triggered these defaults? Was it did you say for that cycle that was also again just bad lending practices?
Yeah, bad S&L, bad lending prices. Yes, bad lending.
Okay.
A lot like what led up to the GFC, but more on the commercial side of it.
Got it. Okay. So I'm hearing a lot of, kind of like you said, history doesn't repeat, but it rhymes. I think I can't remember who said it, Mark Twain or Lincoln, one of those guys. So I am already hearing repeatedly, in the 07, 08 too, there's a lot of bad lending or people, lots of high leverage. How do you feel about right now in our situation? Is it?
Well, I already felt the market about a year and a half ago. We started to pivot in our business, and by pivot meaning I was building 30, 40 homes a year in Portland, and I'd be like everybody else. I'd give whatever the bank would give me max leverage, I would take. The project we are doing now in Canby, Oregon, instead of max leverage, we paid cash, and we have so we're in a position with that property is if we have to slow down and our sales are half of what we thought they were, we'll still be fine. Our returns won't be quite as good, obviously because you don't have as much leverage, but we have way more safety. So on the pivot, to me, is what I'm saying is that a little more equity into the deals to give yourself a little more of a cushion, a little more reserves, to ride through. And then if you can put cash together, cash is going to be, we're all seeing the credit dry up, especially for investor product. I was talking to a couple of the hard money guys in the Bay Area, matter of fact, and they've just totally cut off. And I was talking to one where, they only want to do 50 to 60%, loan to cost. So if you're buying a flipper in the Bay Area that costs you $2 million, you're going to need $1 million down.
No, loan to cost, not even LTV.
Yeah.
So I sometimes hesitant to ask this because nobody has a crystal ball, but just wild guess or personal feel, where do you think we are right now? I mean,
it's very, very difficult for me because no one's lived through this. I haven't lived through this. All I'm saying is investor credit drying up, especially a lot of the people that went to do the BRRRR. I see deja vu all over again. What happened to me in 08, 09, when I had all those hard money loans out in the Midwest and people couldn't get a refi on their, $100,000 rental and wherever. And a lot of that's a problem. So whoever can find the lenders that will still do investor loans, that is a key, because a lot of them have stopped, and a lot of them were going through the non-QM. So they're going to have to find the qualified mortgage lenders, the banks in the Midwest that will do this. But the non-QM folks that were packaging this stuff up and selling it on Wall Street, that's all pretty much stopped. So, you know, that's a major issue, especially if you're like a private lender lending somebody money and they're gonna pay you back by refinancing, but they don't qualify at the bank and they were looking for, you know, non-QM type loans that Wall Street was buying. You know, that stuff has dried up.
Okay. And how are you guys looking at deals right now? Because I think you mentioned usually, at least during the acquisition or the entitlement phase, you guys are mostly just cash, right? But are you sort of, and sorry, I know your answer to this already since we talked before, but for the benefit of everybody, like, are you just sort of sitting on your hands right now, or are you actively, or, you know, sort of same as usual, or are you actually getting more aggressive?
No, our volume is down. We've bought, you know, I bought a property here in Vegas, but we're like everybody else. We're going to be putting a pretty sharp pencil to it and making sure if whatever we're buying, we're getting a great deal on it. Now, to be fair, we're not buying hold investors. We're buy and flip or buy and build and sell. So, you know, whatever investor that the criteria investor has for a rental property is going to be a lot different than my criteria.
Okay. So what I'm hearing you say, I mean, there's a little bit of echo of the late 80s and the 07, 08, where people are using more leverage. What metrics, or is there something that we can keep a pulse on, if this, you know, if people are sort of getting ahead of their skis in terms of leverage, like that's some kind of industry published data, so that we can, you know.
I'm not aware of anything like that other than, you know, you just have to back of the napkin, scratch out your own stuff and say, okay, what happens if this doesn't happen? Because real estate, whenever you're investing in real estate and you're trusting a third party to make your profit for you, you have to look at, okay, what happened if the third party doesn't come through? It's like the houses we're building in Oregon. What happens if I build them and I can't sell them? They're new construction. Well, I've already had deep conversations with my banker that those will now become rentals, right? And they'll term them out for 5 years and interest only on them so that I can cash flow them, and then I can wait through the cycle. So as long as you have a plan B to get you through a cycle, I think that's smart. If you have no plan B and you're only going on plan A, and the only way that your portfolio works is if plan A works perfectly, then I believe appreciation is gambling, cash flow is gambling. You're gambling on cash flow. And I mean, I lived it. I mean, I was sitting on all these houses in 08 to 010, and cash flow dried up. People stopped paying rent.
Yeah, and I think I meant more, especially since you have been a hard money lender. I was curious if there's some kind of indicator so that people, because I think, for example, people are seeing auto loans, right? Like that sort of kind of really getting out of whack. I was just kind of curious if you know, or maybe looking back in 07, 08, there was some indicator to you that, like, hey, actually, maybe, you know, we're getting too hot or too aggressive. Like we should be careful, kind of thing.
Well, you know, this has come on so fast and so deep and so horrible for the country. No one could have seen what's happening. And I don't think anybody can crystal ball as to what's going to happen in 2 weeks, a month, or whatever. It really has to do with, can people get back to work so that they can pay their rent, pay their mortgages if they own a home, that type of thing. So I don't think, if you get caught in this situation and you're having financial problems, other than maybe you should have had some more reserves. You can't really kick yourself in the butt too much over this, because who was to see this coming?
Right.
I mean, there was nothing. I thought, like I said, in 18, things were starting to slow down. I thought we were going to slow down a little quicker, and then it just bounced right back. So I was wrong about that.
What made you think that or say that?
Sales,
Just the market
sales.
reaction? Okay.
Yeah, interest rates were starting to go up, and sales were slowing down.
Was well, I was gonna ask, with the chicken and egg, which came first, the higher interest rate or the slowdown? But
They're kind of symbiotic. They
yeah.
go together.
Okay, great. Well, again, guys, feel free to pop in your questions in the chat box. I mean, Jay, thank you so much for your time. Honestly, I think the two biggest takeaway I have, from Yushin, again, the leverage side of thing, on the things that you have control over, you're personally as an investor, how well you're capitalized. Do you have a plan B or maybe even plan C? And it also sounded like today, the environment that we're in, it's very externally driven. It's an event driven thing. It wasn't like in the FNL or in 07 or 08 where they're just a lot of people doing a lot of dumb, stupid things. So at least that kind of gives me hope that, if we have a drug or some kind of treatment or vaccine, we can, or at least, in the meantime, we can return to 80%, 90% normal kind of thing.
Well, one of my thoughts too is, I don't think folks realize, especially in middle America, how many people own their homes free and clear. It's a staggering number. And then a lot of people have gotten great interest rates. They bought their properties coming out of 2010. They got great deals on them. Their mortgage payments are less than rent, a lot less than rent. I mean, I look at my house up in Lake Oswego, and my mortgage payment is way less than what I could rent the thing for, and it's a executive home. So I just don't see the same things lining up for some, like, okay, I'm going to wait on the sidelines because there's going to be massive defaults of homeowners. You're going to have people, if they're out of work, yeah, I get that. But you're also going to have a lot of people that they're going to be able to ride through this. One way or the other, they'll get through it, because either their mortgage is so low or they have no debt on their home or whatever. Now, can't say the same thing for commercial real estate, people that own hotels that may not come back, and small businesses, that's different. But for, the single family side of it, I'm not sure there's going to be some epic meltdown, because it's come on so quick, and hopefully it'll be over. And it's people can make it 4 or 5 months in an upset. You have to remember that back in the GFC, that rolled us onto us into 27 and didn't really stabilize at bottom till 2010 or 2011. It was 3 or 4 years in the making. This isn't even 2 months. So that's my hope and prayer for our industry, that this short-lived, and there's going to be some panic selling, and some people are not going to be prepared and going to have to sell. But I don't see personally, I just don't see a massive devaluation of single-family residential.
Income. Yeah, I mean, I think I tend to agree too. Like, there'll be deals or some things that people that have to sell, kind of like, I mean, that is a double-edged sword sort of thing. But is it gonna, I think that sometimes people are like, oh, I'm expecting, everything's gonna half off like an 08. I'm like, be willing to put money that's not gonna happen.
Yeah, because credit has not totally frozen. People have to understand. I mean, I lived it. All my lines of credit got called. You go into your office and the bank just called your $5 million line of credit, what you used to make money. And then the next bank called their $5 million. And you get 6 of those all called in 6 months. It was devastating. I had to, I went down to 3 people. And I've stayed at 3 people since. But, credit froze. It's not as available as it's been, but there's still credit. And especially for those that have reserves, they have experience, and good FICO and all that kind of stuff, they'll be able to take advantage. The guy that's been kind of using smoke and mirrors trying to get into properties and all the advantages you can get, they're probably going to get shut out here for the short term, right? But the very capable borrowers still have credit. I still have credit.
Yeah, I mean, I just finished reading Sandel's book, actually, and he talks about, there's a line in there talking about liquidity equals value. Mm-hmm. And like, I literally could not think of a better time than right now. Like, I think a friend of mine, they were trying to buy a 12-unit value add, and lenders are only doing 56% LTV or 60. I was like, really? Like, man, like a month ago, everybody's okay with 80.
Yep. And I don't know that it could be very, very quick to have those lending guidelines get strict, and then it can be a slow melt to get them back to what we had. I mean, it took, like, as a developer, developing lots like we did. When I built one subdivision on the east side of Portland, it would have been 2015, 2016. I'm sitting down with my banker of now almost 30 years. And we're going through it, and he's like, yeah, man, I don't remember how to do these. I haven't done one in 8 years. I was his first underground loan that the bank had made in the Portland market in eight years. And that's a loan to put all the streets and roads in. And those are very, very difficult to get. They just don't hand you. It doesn't matter what your FICO is. You got to have a relationship with the bank. They got to know you, your experience, and that type of thing. And that's the Portland market. Other markets could be different. But it took years for that kind of credit to come back. So it could be quick to have this credit dry up, and it may be a year for it to come back, or 2 years to come back to where it was, in January and February. I could be wrong, and maybe it'll come back quicker. But the sooner we all get back to work and things get back to normal, the quicker it'll start to cycle back.
Yeah. Do you still have turnkeys in Indiana or the Midwest?
I don't have any rental property other than my personal little portfolio of stuff that I have.
Okay. There's a question more regards to just rental prices. I was hoping if you have any insight on that.
Oh, yeah. No, I still fund a bunch of them. I still have interest in probably 50 of them.
Okay. I mean, Do you feel like rental prices will drop accordingly, or?
No, I think it depends on where you're at. If you're in the, to me, the people that are going to get hurt the most here are the people that are, service workers at a restaurant that doesn't open back up, or a small business. They're not really homeowners, never been homeowners. Those folks could have issues. So that's going to translate to their landlord. Like here in Vegas, I'm wondering how the apartment guys are going to do, depending on how many people come back to work and whatnot. But if you go for in the Midwest, and I've said this many, many times on Bigger Pockets, if you just go into a city in the Midwest, look at what the median house price is for a given city, and buy within the bottom or the top of the medium, within 10% of that, you're going to be in basically decent school systems. You'll be able to command rents that are going to be on the higher side, and it's going to keep you out of the stuff that, you're always going to have competition for that rental product compared to, buying the ones that look the best on paper because they're cheap. And, those could easily have either no tenants, like what happened to me. We just had no tenants. And, certain parts of the country got hammered back then too. So,
Yeah, so all kind of comes down to supply demand. If your job has been affected, then and you're doubling up, so maybe that leads to a little bit of more.
and maybe the Midwest will come back strong because this thought of, hey, we need to bring manufacturing back to the United States. You go to the Midwest, they got millions upon millions of acres of developable ground that you could put, manufacturing in. They got the transportation hubs, they got the rail lines. It makes a lot of sense to have
Yeah, I mean,
manufacturing.
I'm actually really bullish on Mexico. I mean, it depends on who's the next president. But we have a manufacturing business, so I think a lot of people are kind of like, oh, hey, hold on, we need, kind of like you said, we need a contingency plan. And Mexico, it makes a lot more sense where the labor prices still make sense, and it's sort of right in our backyard, just to our south, instead of everybody completely reliant on China. And if something happens, then you're like, everybody's sort of screwed, kind of thing.
Well, one of my business associates is out of Singapore, and their family business is in manufacturing, and it's quite large. And when we were over there for New Year's in February, not this February, of course, but the February before, and talking to his father, who's built this conglomerate, they're moving out of China, and they're going to Vietnam, they're going to Malaysia. They're already looking for less expensive labor. To them, they feel China is expensive labor.
Yeah, it is. I mean, a lot of people have been going to like Malaysia, like you said, or Vietnam, depending on what industry you're in. Hey, I'm gonna try to pivot real quick. Chris, can you hear me?
Yeah, I can hear you.
Oh yes, you're unmuted. Do you mind if I put you on the spot for a little bit?
I thought I was gonna be an audience member, but yeah, sure. What do you got?
Yeah, sorry. Honestly, nobody knows the blending business better than you do. I was hoping to have you provide some insight. Just, it can be as broad as what you're seeing in the market, or and you can get into as much detail as you want. So.
Sure. So broadly speaking, Jay is absolutely correct in everything he said.
And
Non-QM.
can you introduce yourself real quick too?
Sure. So my name is Chris Mason. I'm an independent mortgage broker here in the Bay Area of California. I'm a Bigger Pockets participant. Me and Jason know each other from before, and I think I've spoken with Jay a couple times before too. Jay Hinrichs, that is. So that's who I am.
Okay, and then so what's been kind of happening in the credit or capital markets?
Sure. So as Jay indicated, non-QM died overnight. It was the fastest growing segment of the mortgage market for about 3 years, and then boom, just like that, it was gone entirely. So that part is absolutely true. In terms of the Fannie Mae and Freddie Mac stuff, the big thing going on is nervousness about forbearance. If all the tenants don't pay their rent because evictions are suspended, and then all the borrowers don't pay their mortgage because forbearance is a thing, a lot of the loan servicers are still on the hold to pay the bondholders those payments, even though they're not getting the underlying mortgage payments. So you keep kicking the can down the road. Eventually, it does make it a lot harder to get access to credit. Fannie and Freddie have, in the Treasury Department, have announced that they're buying unlimited amounts of mortgage-backed securities, but the private sector is allocating where that mortgage money goes. Right now, interest rates and all that, and how available credit is better than it's ever been for people that are W-2 vanilla, single-family owner occupant, first-time homebuyers type stuff. As soon as you start getting anything exotic, whether it's multifamily, investment, cash out, high balance, etc., things are actually about as bad, if not worse, in terms of interest rates than before coronavirus hit.
Okay.
So there's still, cash out refinances and investment property stuff is still happening. It's just a lot tighter and a lot more restrictive. To what Jay said about people should have more reserves, it's not going to be they should. It's going to be that the banks are going to require it, not straight from Fannie Mae, but each individual lender is trying to deal with the fact that on April 1st, 1/3 of renters in the United States did not make their rent payment on time in full. So when that's the case, and then it comes to, hey, can we count rental income? what rental income? What, does that make sense?
Yeah. So I mean, you're saying QM stuff is just fine, or Fannie Freddie stuff, it's pretty much, almost same as before, but non-QM things are a
Oh
little bit.
no. So let me restate that. Non-QM basically doesn't exist anymore as of weeks and weeks ago. Everything I was just saying is applicable to the Fannie Mae, Freddie Mac agency stuff. So as you know, and as many of the audience members might know, I do a lot of mortgages on 2 to 4 unit rental properties that are Fannie Mae type loans. So I've been talking about Fannie Mae loans, the 30-year fixed, the good interest rate, and all that. Those are more restricted too, unless you are a 100% vanilla W-2 salaried owner occupant type home buyer or refinancer.
Okay, got it. Thank you for that.
Sure.
If anybody has questions for Chris on lending side, you can pop it into. I'll try to either call him again or have him provide his contact information. You can reach out to him. We're kind of approaching the top of the hour here. I'm just curious too, Jay. Like, you've done a lot of things. You've built houses. You've done home running lending. You've done turnkey. What's your favorite or least favorite method of investing?
Well, timber honestly was my favorite because it got me out into the woods, and I love the speed of it because we could buy a timber tract, we could log it, we could have all our money back in 30 days plus a profit, and then have the residual land to sell. That was the most fun, the least stressful. I like that.
You're not looking at yourself, right? You just hire somebody to log it and sell it.
Yeah. We didn't own any equipment. We subbed everything out, but it was a great business.
Do you ever let them grow back?
Yeah, we replant them all. I mean, I've replanted millions upon millions of trees. My company personally, millions of trees, hundreds of thousands of dollars worth of trees every year because we have to by state law.
How long does it take for them to grow back to?
They get noticeable at 10 to 15 years, and they're worth money at 50.
Okay.
So, yeah.
Sounds pretty passive and renewable energy or renewable resource.
And I like the lending business when things are stable, and then the new home construction. We've done very well with that. A lot more moving parts there. Having to manage subs and everything is a whole thing. Probably the least favorite is the having to refurbish old houses, and kind of what the people run into. I see on the bigger pockets where they're trying to buy a little rental house, and to make the numbers work, they got to get the rehab done super cheap, and to hire the person that's going to work for super cheap. If they don't steal their money, they do it wrong, or they do this, that gets very frustrating. So that's my least favorite is dealing with the lower end rentals that we have to rehab to make all the numbers work, because you just don't have the budgets. On the new homes, it's much easier. We have everything's brand new, and you have a budget, and you know it ahead of time, and it either works or it doesn't.
Okay, great. Well, I've really enjoyed the conversation. I look up to you. I really enjoy our conversation whenever I get a chance to talk to you, and just, a fountain, a wall of knowledge to learn from. I hope everybody enjoyed this conversation as well. We have 5 minutes left if you want to pop in your questions. But we got another one coming up tomorrow with Neil Bawa. I think these virtual meetups have been working out pretty well. I think most people are at home anyway, and gives me an excuse to get people that have busy schedules or hard to travel to just hop on virtually over Zoom here.
Yeah, I've been getting, I used to get offered this stuff all the time, and then I was like, I don't really want to do it. Now I'm enjoying it. I think this whole Zoom thing is pretty cool. So, and I'm happy to share and for whatever it's worth. I mean, I'm not God's gift to real estate by any means. I've just done a lot of different stuff, so I can, these are just my personal experiences. So
No, I mean, it's
everybody take it with a grain of salt. I've had my share of pain, and I've had my share of really good days. So
yeah, I mean, and so I never done this before, but I'll try. I did actually. Remember to record this one 5 minutes too late, but I'll try to put it on YouTube if anybody want to rewatch it. If anybody have any questions that wanted to reach out to me on anything real estate or just we own a couple small businesses as well, so feel free to reach out to me.
If you don't mind, Jason, I'm going to send you I finally broke down and we created a website because everybody was, Jay, what do you do? And I didn't have any media presence. So we've put together a nice little website that shows all our projects and real time and everything.
Yeah.
So if you want to post that, however you post that for folks, they can get on our website and see what we do.
Yeah, I can for sure. Do you want to talk about your nonprofit a little bit as well, or?
Oh yeah, for sure. Thank you for bringing that up. Yeah, we started a Hero's Home, and I did that with Chris Clothier in Memphis, which everybody knows Memphis Invest. Brian Burke up in Santa Rosa, he's started as a police officer. Tom Gimmer out in Maryland, owns a title company out there, and then Brandon Hall is a CPA, and then myself. And it was kind of my idea of sitting around Christmas a few years ago, because I donated when I came through the GFC, and I had a bunch of these houses. I ended up having to give about 20 of them to Habitat to Humanity. They were just not. They were just in not good enough shape that I wanted to deal with them. And so I thought, I'd rather, instead of giving it to a big organization where, a lot of money is going to management and marketing and all that stuff, I'd like to put together my own little one. And then, and we wanted to give a home away in Memphis to a first responder hero. And we're almost there. It's going to be about 2 years to do it. I thought when I came up with the idea naively, everybody would be great, I'd raise the money in 2 weeks. But that didn't happen. So yeah, we're at about in the 80,000 range. We want to have about 110, 120. And then we're gonna donate a house to a first responder.
Oh, nice. I got a quick question here that I just saw came in. If you weren't working in real estate, what would you be doing?
I wanted to be an airline pilot.
Oh, no way.
Yep.
Brian's got a pilot license.
Pardon me?
Brian Burke's got a pilot license. He flies over to check out his properties.
Yeah, we have the same airplane actually.
Oh, no way.
That's how him and I kind of bonded a little bit. We both have Cirruses. I'm not current, and I've sold mine to my partner. I lost my medical, so I can't fly anymore. But yeah, I've been a private pilot for 35 years. Owned numerous airplanes.
Okay. Well, Jay, again, thank you so much for your time. Hope you're staying cool in Vegas, and safe journey back to Oregon. Well,
thank you for having me on, and all the people that were watching. I hopefully, if there's any takeaway, just make sure you beef up those reserves so we can all weather this. We don't want to see anybody getting in financial difficulty. So beef up those reserves, look out for good deals, and then just keep moving forward. The world will wake up tomorrow to the sunshine.
Yeah. And we'll have another one tomorrow with Neil Bawa. If anybody is free that wants to join Neil, as some people know, he's very data driven. So he's been keeping track and updating all these data related to COVID. And so he'll kind of have his latest round of what he's seen. And
what I would ask him, Jason, I started a post on Bigger Pockets, who's got their April rent? And either people were fibbing. I can tell you it got like almost 600 responses. And over 95% of the people responding said they got 100% of their rents. So when Chris mentioned, 30% non-pays throughout the country, I'd be interested. Neil's in multifamily. I'd be interesting if what Neil's got on the non-pays.
Yeah, I'll be sure to ask him. There was another one, the builders boardroom that we were in, right? Like Jonathan's team said, I mean, this is through Yardi Matrix, and there's might be some deltas or some differences, but it sounded like it's 84%. This is national though. They didn't break it out by region or asset class. It was 84% collected, but again, are they counting partial payments or are these all full payments? I think, it's ballpark, yeah, like maybe 20-30% delinquency sounded like from different.
I have a business partner that I met him. I brokered a couple hundred units to him in Portland. And I asked him, and he's at 82% for April. Yeah. And these are solid B-class, really nice units. And, he's not they're not a hard driver. I mean, if people needed to do a payment plan, he put people on payment plans. So, but like I said, the bigger pockets folks, like I said, they're either not telling the truth or they're spectacular at collecting rent. Because like everybody, I got 100%. I got 100%. I was figuring some people would get on there and say, well, I have 6 rentals and 4 paid and 2 didn't. But none of that happened. Everybody said they got all their rent.
Yeah, I mean, BP audience, a lot of them might be more like mom and pop investors that they just have a duplex, something like that. I think anecdotally, and I'll be sure to ask Neil what he's seeing too, because I think anecdotally through Brian or through my friend that was on last week, I think 20-30% delinquency is kind of what I've been hearing. So, but all right, well, thank you everybody for joining. I hope this has been great. I see some cool comments here. Be sure to reach out if you need any help. I'm always willing to just jump on a call or see if anybody needs help with anything or connect you to the right person. And with that, I will say goodbye and hope to see you tomorrow.
Thank you.
Thanks, everybody.
Okay, bye-bye.